You may think sustainable growth means growing responsibly or going green, but it doesn't. It has a precise business definition, and if you don't know it, you may be misreading your own numbers right now. Sustainable growth is structural, not values-based. Growth is sustainable when each cycle funds the next one. Specifically, when the returns from your current growth generate enough to repeat that growth without requiring increasing external capital or eroding margins or adding disproportionate cost. Here is the non-obvious part. A business growing at 50% per year can be more sustainable than one growing at 10%. If the faster growing business generates the cash to repeat that growth without outside input. The rate is not the test, the structure is. So how do you know if your structure holds up? Well, there are 3 signals to check. First, margin trend. Is your profit per unit of revenue holding steady or quietly shrinking as you grow? If margins compress every time you scale up, growth is consuming value rather than creating it. Now that is a structural problem, not a revenue problem. Second, customer acquisition cost versus lifetime value. CAC is what you spend to win a customer. LTV is what that customer returns over time. If your CAC is rising faster than LTV, each new customer is worth less than the last one. Growth that works this way is not self-funding, it's self-undermining. Third, cash conversion. Is growth generating cash or consuming it? A business can show strong revenue growth and still be burning through cash if it's funding that growth through debt or deferred payments or investor rounds. Positive cash conversion means the business is creating the fuel for its next cycle internally. Check all 3 of these together. One weak signal might be manageable, but all 3 pointing the wrong way means your growth is propping itself up, and that rarely ends well. But there is one important exception. Deliberately burning capital to capture a market is a rational strategy, and many successful businesses have done exactly that. They invest heavily up front, accept short-term losses, and build a position that becomes self-funding once scale is reached. The difference here is intent. If you know you are burning cash, and you have modeled when it stops, and you have the capital or the investor backing to reach that point, then it's a strategic choice. If you discover you are burning cash because your margins have quietly eroded and your CAC has crept up without anyone noticing, that's a structural drift. One is a decision, the other is a surprise, and surprises at this level are very difficult to reverse once embedded. So here's the reframe that changes how you read your own business. Stop asking, are we growing? Start asking, can this growth continue without propping itself up? If your margins are holding, your CAC is not outpacing LTV, and your growth is generating rather than consuming cash, well, the answer is yes. If any of those 3 are moving the wrong way, and you have not made a deliberate choice to accept that, the answer is no. And the sooner you know it, the more options you have to correct it. Sustainable growth is not a values statement, it's a structural test. And now you know what to look at. If that was of value, subscribe to the channel for one real business question answered every video. For the same clarity in writing, the website and newsletter is 5minutebusiness.com.